2019 is here, and I talk about the stress test coming to private lenders. This is Ken's Take, my real estate podcast. Hi, and welcome to Ken's Take, where I talk all things real estate and business. It's 2019. Sit back, relax, and enjoy this amazing episode. Good Monday afternoon. Could be morning, could be evening, wherever you are listening to. Welcome to Ken's Take. I am Ken, and this is episode 23. Wow, 23 episodes. We are into my podcast. You know, it's absolutely amazing how when you start something, you're a little unsure of how it's going to turn out, but I've gotten a lot of positive feedback, and I appreciate each and every one of you for watching, for listening. Today is strictly audio. I will put it up on YouTube, and but there won't be any video. So if you're watching on YouTube, I will not be coming on camera. I just don't have the time to set it up and edit it today. I want to get this out here. So let's jump right into it. Today, I want to briefly talk about what's going on in 2019 in regards to real estate, and then I want to talk about a pretty important subject that is going to affect every single person if you're planning on buying real estate this year. If you're selling, not going to really matter, as it won't affect you personally, but it's going to affect the person buying your house. So it's going to affect you indirectly, but I want to talk about that and really go over what's happening. So 2019, we are basically 4 weeks into 2019. Hope everybody's having a great year. We have it's been a pretty interesting real estate market. It's been very steady. It's been a steady real estate market. Balanced is the word that I would use. And when I say balanced, what I really mean is the inventory is lacking, but we have some inventory. We aren't seeing crazy listings come on the market, but there is some inventory. The challenge with the inventory, and I think why there's not been a lot of sales, is a lot of clients and realtors are still having a hard time adjusting to where home prices need to be. A lot of clients specifically, and then realtors who go along with their clients' opinions, think that they should be getting crazy money for their house, and it's just not the case. There's a multitude of factors as to why it's not the case. Number one is there's not that many buyers out there right now. There's just not that many. There are a lot, but there's not that many. The demand for housing is there, but at the right price. So there is people willing to buy, though, if you are priced correctly. But it's still difficult to get a mortgage. It's not the easiest thing to do. And it's that is gonna kind of go into my second topic here. But the main reason why homes aren't selling is because you're priced too high. It's just that simple. Your home isn't worth what you think it's worth, and I have no problem telling anybody that, whether it's a client, other realtors, and it's not something that I want to say, disrespectfully or, slag anybody that, your house is none of that at all. Simply put, the demand for homes is not where it was a year and a half ago. It's just not there anymore. And so the other thing, too, is homes have appreciated to a level where they're starting to become unaffordable for majority of Canadians that are looking to purchase. Case in point, I have a home listed for sale in Oakville, 889.9. It's on Stevens Crescent, 602 Stevens Crescent. It is a builder lot. It's great for an investor who wants to potentially rent out the basement, rent out the main floor. It's a great bungalow, 75-foot wide lot, 97 deep. And I really think there's value there if you're going to buy it, rent it out, and potentially sell it to a builder 5 to 10 years from now. I think that's where the real value is. I think you could park your down payment, put $150,000 into it, $175,000 down, rent it out, $3-4 a month, and over the course of 5 years, your rent, if you get $3,000 a month, that's $36,000 a year. So what's that over 5 years? That's going to be about 150 grand plus. So you'll get your down payment back, service the debt. And when I say get your deposit back, you're not going to pay out your full deposit. You have to service taxes, the mortgage, all that kind of stuff. So I take that back. You're not going to pay off your down payment, but you're going to basically be sitting on a property worth one to probably 1.3 in 5 years. And that's if the economy doesn't, take a nosedive and go into a depression. That's another conversation for another day. But it's a safe way to park your money for 5 years. And on that $150,000, if you sell that property for, let's say, 1.1 to 1.2, there's a $200,000 to $300,000 swing there. Pay some capital gains, pay some fees and all that kind of stuff. You're probably sitting on about a $200,000 return on your 150. Not bad for 5 years. Plus, you probably will make a little bit of money each month from the rental income. That being said, for a family looking to purchase that home, it's $900 grand for a bungalow in Oakville. It's a lot of money. It's not cheap. So we have some interesting dilemmas going on with our real estate market right now. Not that it's all negative, but you just have to be very smart when you're going to move. It's that simple. You can't just throw your house up for sale and hope that someone's going to pay you what you want, and then you're going to find the dream house, and it's not how it works anymore. It's just not how it works, and it really hasn't worked like that for a long time. The value of a real estate agent has gone up significantly, and especially for a very good agent, they're worth every single penny. The reason being is I can find you a great deal, negotiate a fantastic price, and as long as we list your home within a sellable range, I will get you top dollar in today's money for what your home is worth. So 2019 is a transition year. 2018 was a transition year, and we're still transitioning. People are going to need to be very conscious about their prices, and but the opportunity to sell your home for a great price and find a deal, it's out there. Now, what's going to complicate this is our next topic, and this is something that I've wanted to talk about. That I've sort of been coming into and understanding. The private lender market in Canada has exploded. Okay? We're talking about $100 billion of private money is in the real estate mortgage market. It's 1/10 of Canada's $1.5 trillion mortgage market. Meaning private investors, whether they are institutions, credit unions, wealthy individuals, REITs, there's a multitude of different private lenders. Basically, they will lend to someone that wouldn't normally qualify to bank. A lot of small business owners, for example, that have a hard time showing income, they will go to a private lender. Instead of the bank paying the bank, let's say 3 to 5% interest, you'll pay 5 to 8% interest, but you're going to get your mortgage. So it's going to cost you more to get your loan, but you can get your loan. So there's been an explosion of that because back in January of 2018, the new B20 rule required banks to test borrowers' ability to make repayments at 200 basis points above their contracted rate, basically 2%. And that's resulted in more applications at traditional banks being rejected. So, you would say the interest rate was at 3%, you'd have to qualify at 5%. And you could qualify at 3%, but you couldn't qualify at 5%, and so you wouldn't get a mortgage. Well, you got to have a place to live, and people still wanted to buy that house, and so they would go to alternative lending. Private lenders you don't have to qualify for these stricter mortgage rules. So they're like, come to us. You're going to pay a little bit more money, but we'll get you into your house. they are not regulated. And so the government now wants, specifically provincial regulators, want to supervise these private lenders, and thus you would be qualifying with them at the new mortgage rules. I disagree with this. I feel as a human being of age, an adult who can make a conscious decision to get into bed with a private lender, if I can't make my payments, the private lender takes my house. It's the same thing with credit cards, the same thing with any loan you make, a vehicle loan. If you stop making payments or you can't afford it, you're going to lose that asset. So for the government to now have to regulate private lenders, there's not much left unregulated. And I don't think that having this industry unregulated is a bad thing. They're not dishing out subprime mortgages. They're not giving out mortgages with zero down and 120% loan to value ratio like they were doing in the States, which was basically the recession of 2008. So they're not doing that. They still have some fairly stringent and strict rules in terms of private mortgages. But this is going to throw a massive wrench into the system if the government does follow through with this. Basically, mortgage investment companies pool funds of wealthy individuals to lend to homeowners and have been the main driver of private lenders' growth, according to mortgage experts. And this article was on HuffPost.ca. Matt Scuffham, I believe. Sorry, it was from Reuters. He's from Reuters. HuffPost picked it up. So he wrote about this. Picking up borrowers spurred by the banks. So these mortgage companies are picking up these buyers that can't qualify. These MICs, mortgage investment companies, lend up to 90% of the property value, typically charge borrowers annual rates above 10% and sometimes as high as 15 or 20 compared to 3 to 5% offered by the banks. Investors in these MICs are typically offered returns between 6 and 10%. So I had said they're above 5%, and they are. They can go astronomically high depending on the situation. Some economists say that they're likely now to account for more than 10% of the residual mortgage market. CIBC chief economist Benjamin Tal estimated private lenders could increase their market share 15 to 20% if regulators do not act, and said that they should be subject to the B20 rules immediately. Why is Benjamin Tal saying this? Because he works for CIBC World Markets. So, of course, when they're losing market share, they want everybody to have to play by fair rules. The difference is that the private mortgage companies are not the same as banks, even though they are. And let's talk about this. Private mortgage companies take investors' money and lend it out. Banks take your money, my money, any money that's in the bank, and they lend it out. There's no difference. The difference is that banks are allowed to do it 20 times and sometimes even higher per dollar in the account. It's insured. Where a lot of private investor money is not insured, meaning if you put $100,000 into one of these mortgage investment companies, it's not necessarily insured. You could lose it. And there has been cases of that. I believe Fortress Mortgage Development Company, land company, private equity company, they lost a lot of money. A lot of investors lost a lot of money. So the big banks are not happy. They want the regulation to happen with these mortgage companies, investment companies. And I disagree. I don't think they should do it. I think that it should be a little bit unregulated. There should be some unregulated options, because if you want to take on the risk, you need to be able to abide by the fallout if you can't and fail on your mortgage payments. If you can't do it. So we're entering into, to sort of sum this episode up, we're entering into a very interesting real estate market. and we have been for the last year. We're not just entering into a very interesting real estate market. We're entering into a very interesting economy. There's a lot of things at play, both positive and negative. A lot of things. A couple things that are negative or potentially negative, not negative, but they could have a negative impact on our economy is elections. We have elections coming up both in Canada and the U.S. We've had a very unsettling and unpredictable president in the States, where things are constantly changing. There's always something happening. There's never, it's not been balanced. We have no clue what's coming tomorrow. And with a simple tweet, things can change dramatically. So we have a lot of uncertainty in the markets, both in America and globally. A lot of things globally have changed how we do business. And a lot of countries are picking sides. They're now having to pick sides with who they're going to work with, who they're going to partner with. We have a lot of political unrest. You look at Venezuela, the leadership down there is changing potentially. Countries are picking sides as to where they're going to go. So there's just a lot of unrest. We have some positive stuff. There's a lot of foreign investment, a lot of Chinese investors that still want to get their money out, and they'll pay that foreign buyer's tax. There's a lot of immigration coming to Canada, legal immigration. People that have money that want to come into our country. So we have baby boomers. We have millennials. We have a fairly good job market. There's still a lot of positives in the economy. So it's an interesting time right now. It's a very interesting time. Nobody has an answer as to what's going to happen. Nobody has the magic ball. Nobody can see into the future. And if anybody says, yeah, this is going to happen in the next, 24 months, no one has a clue. They have no clue what they're talking about. Nobody, myself included. Everything that I am basing my projections on are simply just projections. I'm taking relevant information today, but that relevant information could be thrown in the garbage tomorrow because something dramatic can change. It can change dramatically. So what I would say is this. If you're thinking about making a move, if the time has come for whatever reason, you're growing your family, there's been a death in the family, there is, kids are moving out, you need to downsize, maybe there's a divorce happening, whatever the reason, now is the time to make that move. Do not wait 6 months, a year from now. If you're thinking about making the move, and the reason is simple, we can control today what we can control, but we can't control tomorrow. We can't control the future. We have no clue what's going to happen. So take control of today and act on whatever you're planning on doing. That's it. Episode 23 in the books. Thank you so much for listening. Ken's Take, the real estate podcast. I appreciate it, and we will be back soon. We will be back very soon. Have yourselves a great day. Have yourselves a great week. And stay out of the snow. It's snowing like crazy.